So the New York Stock Exchange is actually the biggest stock exchange in the world for the secondary market. If again, to reiterate, this is where investors come together. It's the biggest stock market in the whole world, right? And NYSE, it came into being in 1792, right, bicentennial, 200 years in 1992. The NYSE has occupied its current building since early 1900s. For 200 years, the NYSE was a not-for-profit organization. So it went public back in 2006, and it listed itself where? On New York Stock Exchange. Yay, of course. So in 2007, it merged with Euronext. In 2013, it merged with Intercontinental Exchange. These are exchanges from, Euronext is from Europe. Intercontinental Exchange is from the UK. NYSE is the largest exchange in the world. Combined market cap as of 2023, $25 trillion. As of 2024, over $30 trillion. Historically, NYSE had 1,366 exchange members. They were said to own seats, collectively owned these 1,366 members. They collectively own the exchange. Okay, even though professional manage the exchange, right? Like the owners do not necessarily need to be the managers, right? Or the professionals. Regularly bought and sold seats. The record seat price was $4 million in 2005. If you wanted to buy a seat to be a dealer, right, you would pay $4 million. In 2006, this structure changed when NYSE went public. Instead of purchasing seats, now you purchase trading licenses, right? So when you buy trading license, you do not own. You just have the license to trade. Okay, so that's the difference between owning a license versus owning the seat, like before 2006. So now the number of that license still is 1366, same deal like before. And these folks who buy the seats, they are called as designated market makers. I said folks, but these are usually like big investment firms, right? Banks like JP Morgan and Chase, Morgan Stanley, right? Having a license entitles the holder to buy and sell securities on the floor of the exchange, right? Only those who have license can actually be physically present in the NYSE to buy and sell. There is something called as the designated market makers in NYSE. Okay, so who are they? They play a very important role. They ensure that there is fair and orderly trading, right, for specific stocks assigned to them. So maybe some designated market makers are assigned Walmart stock. So they ensure that there is enough liquidity for Walmart stocks, I believe. Yeah, right? And you know what liquidity means. Anytime anybody wants to buy and sell, if they can do that, we say the market is liquid. So the job of designated market maker, the role is to play the role of those who create liquidity, right? They create liquidity. They provide price stability as well, right? By providing the security at competitive price. They can also compete against other exchange members for trade. Okay, competition is usually good for the customers anyway. And within New York Stock Exchange, you can also have supplemental liquidity providers. So they're supplement to the designated market makers, and they are high volume trading members. That's what they are, who add liquidity to NYSE. And again, these are big investment firms. They trade purely for their own accounts. They're given a small rebate on their buys and sells to encourage them to be more aggressive, because the more aggressive these buyers and sellers are, the healthier the market is, the more liquidity there is in the market, right? You want there to be more buyers and sellers if you want liquidity. SLPs can trade the same stocks as the DMMs, but they only do it for their own account, like we say here. They can trade only from offices outside the exchange. DMMs are located on the floor of the exchange, right? Okay. So the largest number of NYSE members are registered as commission broker. right? They're there to make money. Commission brokers, like I said earlier, brokers bring buyers and sellers together. Okay, they do not own, they do not buy and sell for themselves or for their own account. They bring buyers and sellers together. When commission brokers are too busy, they may delegate some orders to floor brokers or $2 brokers for execution. Okay, so these are additional brokers who are helping the supplementary brokers, the DMMs, right? A small number of NYSE members are floor traders who independently trade for their own account. Okay, so again, these are all folks who are working for investment firms. Okay, big banks, right? So moving on to New York Stock Exchange, right? The largest exchange in the whole world. Okay, so as of July 2024, there were 2,200 companies listed on the NYSE, and the total market capitalization was $28 trillion. If you're like, what does that mean? What does market capitalization mean? It means the total value of all of the stocks of all companies listed on NYSE, those 2,200 companies, that is $28 trillion. Okay, and this represented nearly 1/4 of the world's equity trading, just one stock exchange alone. That's out of like about 60 exchanges around the world. Okay. Initial and annual listing fees are charged based on the number of shares a company has, right? To apply for listing, companies have to meet certain minimum requirements with respect to the number of shareholders, trading activity, right, in terms of volume and the price, the number and value of shares held in public hands, and annual earnings. Actually, New York Stock Exchange is the most strict exchanges in the whole world. Okay, they're very particular about these requirements. So what are the different types of orders in New York Stock Exchange? What kind of buying, selling, how does it really work? So that's what we're talking about. So the market orders, you specify the asset and quantity. That's what market order means. You go and you say, I want this many assets, okay, sorry, this many stocks of Apple, and immediate execution happens at the best available price. Okay, so market buy will be executed at the lowest possible price, right? Market buy means buying. You want to buy lowest. When you want to sell, will be executed at the highest price. Okay, so that's what that means. There can also, so that is about market order. Okay, but you can also have limit order. With limit order, you specify the asset, you quantity, and price as well. So you will be like, if I can sell, let's say Walmart stock at least at $50, then sell. If I cannot sell for 50 or more, then I will not sell. So if it is selling for 49, you will not sell. That's a limit. Okay, same thing with buying. I will pay at most, let's say $50 to buy Walmart stock, then that's limit buy. Okay, so there can be limit buy, limit sell. Sell, you want to sell at higher price, let's say 50 or more. Limit buy, you will buy at 50 or less. Okay, that's called as limit order. With market, you don't fix price. You just say, I want 10 Walmart stocks at best price. So this is at best price, this is at your price or better. You can also have a stop order. So stop order is when, like, let's say you want to sell, you already have bought, you want to sell, you will say, if the price falls below this level, then sell, otherwise don't. So let's say for Walmart stock right now, let's say Walmart stock is trading for $60 and you will put stop dollar at, let's say, $55. So if the price starts to fall below 55, then you will sell. Then automatically your at $55, if the price goes to 55, then your order, that stop order, will automatically convert into market order, meaning sell right now at the best price. So if the price goes below 55, then your order becomes sell at the best price. But if the price stays above 55, it will not go into any order. It just stays at stop order. Okay. So you are interested, so an example, pop quiz, you are interested in purchasing Apple stocks and have just placed an order to buy 100 shares of Apple for $200 per share. Which option accurately describes the type of order you have placed? So you are deciding how many quantity, right? You are deciding the quantity. You are also deciding the price. So if you are deciding price, then we say what order is this? This would be the limit order, right? Because you are putting the limit on the price. Okay. So moving on to the next one, you want to purchase 100 shares of Apple stocks. You have placed an order specifying that you are willing to pay a maximum of 25 per share. Additionally, you have set a trigger price of $24, indicating that the order should be executed only if the Apple stock price reaches at that level. Which type of order accurately describes this situation? So what do you say? So first thing, you are deciding the quantity. You are deciding the price, maximum price, so you're putting a limit on how much you're willing to pay, but you are also putting one more condition that the price has to go above 24, then only you will buy. Because below 25 for 24, maybe the stock is not good, okay? Because it probably will continue to decline. But if it has gone above 24, maybe something good has come out of this stock. So oftentimes people do that, okay? If a stock price is going down, they don't want to buy. Maybe it will continue to go down. But if it starts to come back up, then that's when I want to place an order, okay? So here you are deciding quantity, you are deciding price. If there was only $100 and this $25 maximum, then you would say limit order because you're putting a limit on the price. But here it says trigger that only if the stock goes above $24. So that means this is a stop order. So you would say stop limit order, because you are willing to pay maximum 25, okay? And stop because you are putting a stop. Until then, the stop means until then, do not use this order. Do not use the limit order. So this is a limit order, but do not trigger that. Do not use it until the price goes to 24. So stop the order until it's 24, right? So that has to be stop limit order. All right. So when you see question like this, you want to ask first, if it is only quantity, that's a market order. If there is price, maximum price you are willing to pay to buy, or the minimum price that you are willing to sell, then we say that's a limit order, okay? And if there is a trigger price either to buy or sell, then we say that's a stop order. So this is market, that's limit, that's stop, okay? So stop limit order. So that's what it explains here. So I'll move on because I've already explained that. Also looked at the example. The flash crash of 2010. This happens. Okay, sometimes there has been times where the stock market suddenly crashes out of nowhere. Okay, and for example, this is an example of 2010, and like that, there are other examples. Maybe during the COVID pandemic, maybe during like 1987. In October of 1987, there was a really bad crash. So there has been a few of these really bad crash when there is some kind of interesting, bad, completely unexpected news. Okay, so federal regulators blamed automated trading software for that flash crash of 2010. Liquidity crisis, many sellers, few buyers. Okay, Dow Jones plunged about 1,000 points in minutes. That's about 10% within minutes, entire stock market, right? And 10%, is that a big drop? That's a big drop, because throughout the day, oftentimes if they increase by like 0.5%, 0.3%, that's already big. So moving by 1,000 points, 10% within minutes, that's massive, okay? But they say it was automated trading software. Some problem happened, okay? Some technical problem. And if there are potential for such crash to happen, and this time this crash happened because of technology, right? Not for any reasonable reasons. So to avoid such kind of extreme fluctuation in price, because extreme fluctuation, it hurts both buyers and sellers. Okay, buyers and sellers, none of them can think in which direction market is going, what kind of position they should take. So it creates a kind of like chaos if the fluctuation is massive within a short span of time. So to ensure that does not happen, there is not such kind of mayhem, right, or chaos, then to stop that, there is something called as circuit breakers. Circuit breaker, you all know, right? At home, circuit breakers are like when they completely stop electricity from flowing, maybe because something has happened, right? Something that's risky. Same deal here. Circuit breakers breaks the trading, meaning they cease trading for a short period of time to calm the market. Okay, these trading halts are called circuit breakers. So in response to the flash crash of 2010, regulators updated circuit breakers. They lowered the market-wide circuit breaker level to 7%, implemented individual stock circuit breakers. So if the crash happens by more than 7%, then they will put the circuit breakers. So SEC is constantly tinkering with circuit breakers and studying what triggers them. Okay, could there be some kind of fraud, some manipulation? Was that reasonable? What really happened? SEC, Securities and Exchange Commission, right? Is constantly studying this thing. Trading on the web. So thanks to the availability of online brokers, you can now trade on the web, right? You can just open an account with the online broker and you can start trading. Okay, so for example, like let's say you go here, type trade stocks, okay, on Google, and it will show you all these links. Let me just go into okay, E-Trade. Okay, I'll go into E-Trade. I'm just trying to show you how you could open. So here you could open an account, but I will not go there right now. But how you could actually do the trading. How does the page look like? So that's what I want to show you. So let's say this is Johnson & Johnson. I just click this. Whatever you want to buy or sell, you can actually type up there as well. There is a place somewhere. And right here, right? You can just click this buy. Okay, so you can look at the price. Of course, you want to be informed about like what you are buying or selling, right? So there is snapshot, there are all the charts, there is news about Johnson & Johnson, right? Let's say there is news. So all sorts of things, fundamentals. So you can kind of like do some kind of research and then you can, let's say I like this, I want to buy, if I have, I want to sell. But of course it will not let me buy anything because I have not opened, I don't have any account with them. But you got the idea. I just wanted to show you what the page where you would do the trading looks like. Okay, and when you do that, actually it will have the option of you choosing like the limit order, the market order, the stop loss, and all of that. Okay, so moving on to NASDAQ, the other exchange. Okay, so NASDAQ is derived from the acronym that stands for National Association of Securities Dealers Automated Quotation System. NASDAQ is now a proper name in its own right, so you don't need to say all that. Just say NASDAQ. Everybody understands what NASDAQ means. Okay, so it was introduced in 1971. Computer network of securities dealers, so a network that brings the dealers together, and you know what dealers are, right? As opposed to brokers, they buy and sell securities on their own account, right? To disseminate timely security price quotes. Okay, that is how it was introduced. It is the second largest exchange in the world, right after New York Stock Exchange, and it has 7,000 companies listed as of July 2024, the combined market cap of over $26 trillion, also approximately 1/4, right? Not too far from $28 trillion for NYSE. But the volume on NASDAQ exceeds NYSE volume, okay? The NASDAQ companies comparatively are smaller than the companies in NYSE. Probably that's why, right? Also because it has more number of companies. So NASDAQ trading is almost exclusively done through dealers who buy and sell securities for their own inventories. Okay, the dealers, they use their inventory as a buffer to absorb buy and sell order imbalances. You know what that means? In the late 90s, it opened to electronic communication networks. So that is why you can do buy and sell online, right? Nasdaq. That's what Nasdaq did. Nasdaq. So what are the ECN's websites that allow investors to trade directly with one another, right? A really cool innovation in the stock market. The network provides bid and ask price as well as recent transaction information. Of course, and you all understand that the highest bid, the lowest ask, and you know the difference between bid and ask. Bid is the buying price for dealers, so that's the price at which you could sell. Ask is the buying price for the dealer or your selling price. By you, I mean you and I, individuals, right? Individual investors. For a small fee, you can have access to level 2 quotes as well. Of course, nothing comes for free. If you want more information, then whatever is available publicly, you need to pay for that. It displays all bid and ask, not only the highest bid or the lowest ask, but all prices. Frequently displays the market maker identity. Who is the one who is bidding or asking? So NYSE and NASDAQ competitors, there are competitors to those NYSE and NASDAQ. They are not big, of course. So the third market, that is what it is called as the competitors. Third market means not the exchanges, but something off exchange. Okay, off exchange market for securities listed on an organized exchange. Okay, these are like, for example, Walmart listed on NYSE, but you can still do trading in the third market. Okay. So the fourth market is for exchange-less listed securities in which investors trade directly with one another. So here third market, off exchange market, here it is investors trading with each other. And there can also be dually listed stocks, meaning stocks can be listed in more than one exchange. Oftentimes they list in the national stock exchange like NYSE and also regional exchanges, okay, to attract substantial trading volume. That's the idea. So basically the exchanges, they don't have to be all national, they can be regional. Okay, so like for the West Coast or for the East Coast. Let's talk quickly about stock market index. So if I want to know how a group of companies are doing, then I don't need to like individually look at each company. For example, let's say I want to know how like the top companies in the US are doing. So I don't have to like go to, okay, let me look at the price of Apple and then Google and then Microsoft and then Wells Fargo and then Bank of America, Johnson and Johnson. Instead of doing that, I can look at like a bundle, right, of all of these companies and see what's happening in general for these companies, okay, in terms of their price movement. Okay, so a market index is a hypothetical portfolio, right? Portfolio simply means combination of assets or stocks in this case. So hypothetical portfolio of investment holdings that represents a segment of the financial market. Okay, so methodologies for constructing individual indexes vary, but nearly all calculations are based on weighted average mathematics. Okay, and weighted average simply means give more value to bigger companies like Apple, Google, Microsoft. They receive more weight based on their value of their equity. Okay. So indexes are used as benchmark to gauge the movement and performance of market segments. Investors and fund managers use index as basis for portfolio or passive index investing. So sometimes what you can do is, okay, so these portfolio managers or fund managers who are managing money, right? Sometimes like millions of dollars for their clients. So they use index as a benchmark. So at least you want to generate, right? The portfolio managers, they want to generate the return provided by a particular index. Okay, otherwise you are better off just putting all your money in the index. In fact, that is what I do, right? I like to put, when I'm investing, I like to, if I want to like diversify my portfolio, I just want to invest in index. And let's talk about what are some of those indexes. So there is like Dow Jones Industrial Average, there is S&P 500, there is Nasdaq Composite. okay, and they again serve as a benchmark, right, to measure market performance, okay, to make financial decisions, investment decisions, basically. Okay, so for example, I like to put my money into S&P 500 index. What is that index? That index like is a combination of like that, you know, fund that, or actually the index that tracks the 500 top companies in the US, okay, based on market capitalization. So how are the top 500 companies in the US doing? So at least if I'm fund manager, at least I have to, right, ideally I want to generate that much return. So, that's it. Looks like useful internet sites. So make sure you are, I would say, just go through each of these websites and read about them. Okay, like if you want to know about venture capital, go into this website. If you want to know more about IPOs, go into this site. Don't tell me you don't know what IPOs are. You know what they are right now. So NYSE, Nasdaq. Just I would strongly recommend just go into these and just read, the about page. All right. The end. The end. That's it. That's all, folks. That's all. So see you on the next chapter. Bye bye.